Well, good morning. We're going to go ahead and get started. Welcome to the Venture Trends, or the Trends panel this morning. This is session 2. My name is Steve Smith. I'm the head of business development at a private equity firm called Tower Arch Capital here in Draper, actually, and grateful to be here this morning. I'm sure other people will be coming in and out, and we'll welcome them as they come. I really am excited today to welcome 3 venture capitalists from the local market. And we look forward to having a lively and engaging discussion with Scott Whitehead, Suze Duke, and Tanner Potter. And so I'll let them introduce themselves here in a minute, and then we'll kind of discuss the format of the overall session this morning. But again, welcome. We will have an opportunity at the end to have questions as well, so we'll make sure that this is an informative and interactive session for you as well. So with that, I'd like to turn the time over to, let's start with you, Suze, if you don't mind, and introduce yourself.
Yeah, happy to. My name's Suze Duke. I work at Pelion Venture Partners. I've been there for 4 years. Before that, I worked at Goldman and did a little bit of consulting in between. And let's see, I'll intro Pelion, I guess, too.
That'd be great, yeah.
So Pelion is a $370 million early stage venture capital firm. We're located here in Cottonwood Heights. We invest across the U.S. into early stage software companies. So we invest at the seed and Series A, and our typical check size is anywhere from 1 to 3 for seed, and Series A 3 to 10. So that's us.
Great, thank you. Go ahead, Scott.
Oh, awesome. I'm Scott Whitehead. I work for Elevation Capital. Before Elevation, I was doing consulting with McKinsey, and before that, I worked for a startup. And I left the startup because I was like, this isn't a rocket ship. And then they raised last year at a $2 billion valuation. So that was my first miss in venture. But that was a good time. I was the first employee in the U.S., and it was fun being part of a fast-growing team. But Elevation Capital, we've been around for 20 years, investing predominantly in India. And then myself, our founder, and my counterpart at the fund are from Utah, and we opened a Utah fund 2 years ago, and we're on our 8th fund. It's a $670 million fund, predominantly Series A focused, with a Series B and a seed here and there.
Great. Thank you, Scott. Welcome.
Yeah, my name's Tanner Potter. I'm from Kickstart Fund. I'm not from there, but I work there. My background's primarily in products, so I worked at Vivint locally as a product manager, so designed and built cameras, indoor cameras, outdoor cameras, doorbell cameras, and other products there. I spent some time at Nike in product as well, and got an MBA, and then joined Kickstart about 2 years ago. Kickstart's thesis is really, since 2008, we focused on investing in the Intermountain West. So Gavin, founder, made a bet early before it was obvious that Utah and Colorado and Arizona would have a budding tech ecosystem, and we are now investing out of our 6th fund, around $170 million fund, and we focus on pre-seed and seed, so we like to be as early as possible.
Great. Thank you, Tanner. Again, welcome to the venture capital discussion. The way we've formatted the discussion here is what we'd like to do is start kind of on the macro. We're going to discuss kind of some of the macro trends in the venture market, what the panelists are seeing across their portfolio from a macro perspective, as well as new investment opportunities in the macro environment. From there, we'll talk a little bit about the Utah market. Love to hear a little bit of your thoughts on Utah, particularly in what's happening in the space here. And then we'll talk specifically about deals, deal-related terms, valuation, and kind of more on the micro aspect. And then what we'd love to do is spend a little bit of time at the end talking about the role of the finance professional throughout the investment cycle. So communication with investors, how you think about raising, what happens from seed all the way through to an IPO or an exit, and talk a little bit about that as well. So with that, let's start the discussion on the macro environment. Recent reports obviously show that fundraising is down this year, 2022, versus prior years. We've had several years of robust investing in the venture space. We'd love to hear your thoughts on what you guys are seeing from a macro perspective. You know, with the fundraising market down, how is that affecting your investment thesis, or is it? And then from that perspective, how is it affecting your portfolios as well?
I can start. So interestingly, at the earliest stages, Pelion hasn't seen too much of a slowdown at the seed and Series A. And when you like zoom out and look at the macro environment and just like overall stats on the slowdown, there's been like, I think like a 15% decrease in the capital deployed at the seed and Series A. But as far as like the number of deals go, it's actually increased 1% year over year. So at the earliest stages, depending on what stage you're operating at, there actually has been very little slowdown at the early stages. It's when you get to the later stages that it's really slowed down by like 70% or even higher. There's I think firms are being a little bit pickier about where they're investing. I know that Pelion has seen that. We're looking at the spaces that we're investing in a little more closely to make sure that they can make it out of the downturn, and a higher focus on unit economics and growth. So,
Yeah, I would. So, in addition to pre-seed and seed and Series A still happening, but Series Bs and Cs and Ds, are significantly harder. I think there's some unique dynamics in the market. I read yesterday that there was about $290 billion in dry capital. And I think if you look at 2020, 2021, I would guess that most funds have a 3 to 4 year investment period, and most funds paced ahead of that. And so you have a unique dynamic where you have a lot of dry capital that needs to be deployed over that time, but investors coming out of a super bull, a very bullish market. And so eventually that money, I think gravity is going to expect that money comes out at some point. But I think right now, as with the macro environment, with inflation, with wars, and all sorts of things that are happening that we're all well aware of, I think that has caused investors to be more cautious. So I think specifically when you hear the term like flight to quality, I think a lot of investors are thinking, okay, we spent some time potentially being more speculative in certain industries that don't have proven VC outcomes, and so now you see, I think, of more of a focus on B2B SaaS and those industries where we've seen that track, where people have seen that track before. And that's not true for all VCs per se, but I would say in general, that's a trend I'm seeing.
Yeah, great. Speaking of dry powder, one of the questions I had is you're seeing a lot of a deal size in the venture space, particularly Series A's, being raised at much larger sizes. How does that affect you all from where you sit in your firms, recognizing the funds that you play in? And are you seeing, because of the excess dry powder, is the push to deal size because of dry powder, or is it that firms are waiting longer to actually raise early rounds?
I can only speak to our fund, but I think our view is like fewer and bigger checks. If it were seed, it would probably do different. Great time for seed, sure. Obviously. We've slowed down quite a bit intentionally, whether the market slowed down or not on the Series A. And so, yeah, we just want to find, not that we didn't have high conviction investments, but the bar is really high right now for us. And so I think like last year, last year-ish, we did like 38 investments globally, and I think we've done 3 in the past like 4 to 5 months, and very intentional again. Because I think what we're seeing is like even at the A is most good companies that have cash on the balance sheet are saying, why would I go out and raise right now? Like the valuations are a little bit lower. Maybe I can go get a high valuation, but let's just be more capital efficient and push out that raise. And so in the sense, it can create a market of lemons where all the people that are raising are just the people who can't raise. But our job is to find the ones that are really good and are running out of cash just because that's what the timing is, right? And so that's what we're hunting for and excited about. But we've slowed down.
Yeah, makes sense. Thank you, Scott. Other thoughts?
I would say on deal size, I mean, I think it's always, the goalposts are always moving as you have this ladder of investments from angels, pre-seed, seed, and what is a Series A now wasn't a Series A in 2018 and what that means. So it's really hard to know why, aside from inflation and that in 2021, tech multiples were so high that it justified potentially, if you're underwriting that and you're saying I can get a 30x ARR multiple, you can overpay and put more money into the business. Now I think there's a little bit more discipline, and frankly, one of the downsides of people raising too much and raising at too high of valuations is, and we've seen this with a number of companies, they get stranded in no man's land where nobody wants to pay at their last valuation because they were, essentially 2 years ahead of their traction on that, or significantly ahead. And so now they either have to do a bridge or recap, and when you have to do that and you have to potentially lay off employees and slow momentum, like that can really hurt the momentum of a company. And so I think it's healthy to make sure that we have valuations in a range, or else you can get stranded like that, and then you're in trouble.
Yeah, makes sense. What breaks free? So let's talk through the next 12 to 18 months, right? Tanner, you said earlier that companies obviously have a decent amount of dry powder. Firms have a lot of dry powder, and at some point that gravity will flow. Conversely, you all talked about pulling back a little bit in the current environment on your investments. What step function change, or what will change that will cause you to rethink deployment of capital, both for your firm but also macro perspective? What is it that breaks free and says, okay, venture's back on and we're on in a big way? Is it, obviously in inflation today, is stabilization of the stock market? What are the kind of key factors that you all are relying on internally to say, yeah, we're ready to roll the dice on these investments?
I think for us, it's not like all of those factors, like macro factors, play into it, right? Like what's the Fed doing? How's overall public markets, and how does that trickle down? But at the end of the day, it's like literally as simple as like, do we like the companies and founders we're talking to?
Yep.
And as soon as there's a higher volume there, like we're then invest more. Right now, we're just finding fewer. Again, like I said, we probably like, to Tanner's previous point of like everyone was kind of maybe exploring and getting a little excited and overheated in the market where it was. But it's really more to us is more of like a funnel issue of like the founders that are coming into our funnel and that we're talking to, and we're slowing down just because we don't have as high conviction on what we're seeing.
It's a quality issue is what I'm hearing.
Yeah, and again, like a lot of companies that have raised seed funds, say like a $3 to $5 million seed, and they have it on the balance sheet. A lot of those companies are like, okay, how do I extend this for a year and a half to 2 years to see where markets are? And as soon as those companies start going out to market, that's when our deal flow picks up quite a bit.
Yeah, makes sense.
It's the exact same thing for us. It's really like, if we find a company that we're excited about and have deep conviction in, we'll back that company. We're not slowing down on purpose by any means for us. It's when we find a company that we love, we'll back them.
Great.
Yeah, and I would say I feel the same. I would imagine that if you think of a VC fund from a resource perspective, with the downturn, employees are spending more time playing defense on certain companies, so that could play a role in terms of the number of resources they're putting towards new deals. I think when you're going early, we're like, hey, we're betting 10 years out, so we believe that multiples will adjust. But when you see certain public companies and they're trading at 2 to 3x ARR multiples, that models don't work for that. And so I would say that things like if those return to let's say like a 10x multiple, I'm sure that causes some of the later stage to loosen up a little bit, and then that can flow a little bit down. I think those are all marginal factors, and as both Scott and Susan said, like we're open, we're trying to invest, we want to invest. And then I think the third potential thing, this is more of a theory, but it seemed to me that out of COVID and in 2021 there was sort of a mania, and so that there's a dislocations that happened where because of COVID people were working from home, and a lot of people said, hey, maybe I want to start something. And I don't have the data on like number of new startups that happened in 2020 or 2021 versus this year, but my guess is it was marginally higher in those years. And so I think in downturns, a lot of people say, hey, I might not take that risk that I thought I did in 2020. But again, more of a theory.
And if you guys want to look for like some indicator of when deal count will start rising and capital deployment, there actually is like a lagging indicator of watching like the S&P 500 and like any stage of early stage to later stage of private capital. Usually private capital follows just a couple months behind the market. And it's probably because, you know, the later stage follows the public market and those indicators, and then early stage follows the later stage. So it's if there is an indicator, it's the S&P 500.
Great, thank you. That's very helpful. If as you invest, it's anything like in private equity, certainly while you're being cautious, there are areas I suspect where you would lean in quite hard. What are those parts of the market that you're seeing that are most attractive despite the economic headwinds? Where are you most excited over the next couple of years for, whether it's technology, healthcare? Which parts of the markets are you most excited about?
I don't know if this is the best answer, but off the top of my head, I would say one, even that we're predominantly Series A, but like right in a down market, like the cliche of like the best companies are, you know, start during a recession. But like if on the seed level, if someone's leaving a good job to go start something, I think the conviction of founders just goes up in markets like this. So for a fund like Kickstarter, I think it's like a great time to find very high quality founders that have very strong conviction on what they're doing. Yeah. And then overall, this is broad, but I think, you know, not that we were investing in companies that didn't have solid unit economics, but I think that's what we're excited about is like, hey, we predominantly invest in SaaS, and it's like, does this scale? Does this work? Like finding companies that can thrive now, and then when a bull market comes back, they're going to continue to thrive. So it's not a specific industry, but I would say our excitement's still there, obviously.
So it's about business model for you more than industry. Yeah, great. Other thoughts?
Go ahead.
No, I was just going to say same thing as Scott. Like we're actually really excited about the seed stage investments that will be coming over the next, 12, 18 months. This is, it's moments of change as one great entrepreneurs emerge, and we're excited to back them.
Yeah, I think there's a little bit more of an adjustment towards proof points rather than just storytelling. So making sure that unit economics, at least foreseeably would make sense. I think that there is less focus on that. I think we've all seen that. I'm sure as CFOs, you've seen like profitability matters, cash flow matters, unit economics matter, all of those kind of fundamentals. And I think there's, I'm really excited about specific technologies that seem to be burgeoning. Like, for example, AI. We've all seen a bunch of stuff around GPT-3, DALL-E, these text-to-image pieces, and so we're really excited about specific technology trends around that. We don't invest in a ton of biotech, but given some of the stuff with mRNA and a lot of improvements in CRISPR in those areas, like I think there's a lot of exciting stuff. And then we're really excited about just like really good B2B SaaS companies where people have deep insights and want to go after it and build a sustainable, great business.
Great, thank you. Can you let's talk through just Utah in general. Obviously, you spent a lot of time in the Utah market. I suspect you have deal flow from here, but also outside of here. Utah has historically been a very entrepreneurial base in terms of the labor pool and just overall mindset. We've seen a shift, however, in availability of capital, funding, good ideas over the last decade, but really over the last 5 to 7 years. How are you seeing the Utah market today from the seed and Series A perspective? Are you seeing more opportunities being presented for both, not just Utah, but also women of Utah? Love to hear your perspectives on the Utah market.
Sounded like
Okay, I'll start. Over the past few years, we have seen more and more deals come out of Utah, which is very exciting. And I think that will continue as, people work in some of the startups that are prominent today and then roll off. We saw a ton of entrepreneurs roll off from Qualtrics after they exited, and I think that will continue to happen as more and more of these later stage companies exit. Employees will leave and build their own companies. We have not seen a ton of women entrepreneurs and would love to see more. I think that that's like a very long-term, you have to be very thoughtful about that long-term and help, more women get into technology backgrounds in school, which, probably starts in high school. And so it's not going to happen overnight, but hopefully we're doing the things that we need to do today. So in 10 years, we see a lot more women entrepreneurs coming through our door. Most of the female founders, I think, in Utah are mostly they're building products.
CPG companies.
And we just don't see, Pelion doesn't invest in those, so we don't see them very often.
It's been super interesting to see the difference between Indian founders and Utah founders. So Indian founders, they're like, look at this product that I built. It's incredible. They were like top of their class in engineering at IIT, Bombay or wherever. And it's incredible. And you're like, go sell it. Like, why aren't you selling it? And they're iterating on the product and it's like, go sell it. And Utah has been the exact opposite, where you're like, wait, who's building out the product? What were you doing before? And they're like, oh, I was working in sales at Qualtrics. And you're like, who's coding it? And they're like, oh, some dev shop. And so it's neither one of those is wrong, right? But you have a lot of like very GTM heavy founders here that are like selling a PDF and it's like working and you're like, oh, your product needs to catch up. And so that's been an interesting learning for us. And look at like I think Blake Murray at Divvy was running a pizza shop before. I think Eric Ray at Podium was just graduated from BYU and did something with Podium. Did something with the World Bank before starting Podium. And so I think the theme for us in Utah is like Utah founders hustle hard and have so much grit. And so that's what makes us excited about Utah. But even in the 2 years that we've been investing here, there's strong indications that like dev is catching up and there's a strong dev muscle here. You have like SoFi who has a big dev team here. I think Workday has like a decent sized dev team here. And so I think over time you'll see those two more equal out, but I think we'll always be known for being like just a sales machine, and that's why we're so good at Utah's so good at SaaS and sales.
Great, thank you, Scott.
Yeah, I agree on both of those thoughts. I remember I guess it was around September 2021, I was on paternity leave. We just had our first baby, and I used that, and one day I'd used an Owlet sock for the baby. I'd adjusted my Pura to make the house smell a little bit better after the poopy diapers, cooked something on the Traeger, like checked my Vivint doorbell. I did all these things, and I was like, wow, that was actually a pretty cool moment to see that, like, we've had a lot of successes in B2B SaaS, but I think, and then we have recursion, and we have a bunch of things that are now diversifying outside of just that lane, and consumer products, consumer hardware, tech, deep tech, frontier tech. So those things, to Sue's point, they take time. The same with getting more women involved. Like, it takes time to build those deep technical skills, those types of companies, and then you see cascades that roll off from those. So I think I'm really excited about that from a Utah perspective. To Scott's point, I think Utah has historically what I would characterize as a lot of mercantile energy. Like, you see that in door-to-door, you see that in MLMs, you see that in tech. Like, people want to go out and hustle and make money. And I think that has resulted in a lot of great sales skills, and I think we're complementing that with some of the requisite engineering skills, which I think is really important. And then from a like women and diversity perspective, I think there's a lot of work to be done there. I think the funds have been doing, I think over half of our fund now is female, and so I've heard like the statement, like, what you can see, you can be, and what you can't, you can. And so I think like that's important from an investor perspective to have female entrepreneurs come in and see females on the other side of the table. And then I think we need to do more to encourage that subsegment and then other diverse segments in the population.
Great. Thank you. Very, very insightful. Let's shift gears and just talk about deal-specific terms now. In the seed round, obviously valuations continue to increase. So I think it's the last 5 years in a row, valuations for seed rounds have just. I looked at the PitchBook data last week, and it's obviously increased quite a bit from a valuation perspective. Still pretty high on seed rounds. What advice would you give for someone here looking to either raise a seed round or getting ready to think about starting a business? So much of the time and energy effort is focused around valuation, but so much of the deal, as you well know, is about the terms. Can you talk to the group here about, your thoughts on juxtaposing valuation versus the terms that you're trying to get in the deal for yourselves, and maybe some of the trends around deal terms, buyer-friendly versus seller-friendly, et cetera?
Yeah, I can I can try to take a stab at that as the resident seed individual. Yeah, so the valuations have definitely come down from where they were. I think if Y Combinator is a leading indicator, people were coming out with a business idea and a team and raising on 30 million post-money valuations, and that may still be happening in YC, but I don't, in most cases, yeah, in most cases it's not.
It's cut in half, so just to give perspective.
Yeah. And if you think about, if I were as an entrepreneur, thinking about from an entrepreneurial perspective, each round I want to at least double my valuation, or I want to increase it. And so when I think about that, and often valuation comes down to actually like how much money am I trying to raise, and then understanding that the VCs or the investors that I'm working with are typically trying to own 15%. You might say 10 to 20% of the round dilution. 20% is more probably typical. It can go higher than that. And so you think like, hey, I'm raising 2 million, multiply that by 5, like a $10 million round. Of course, there's factors like if you're a repeat entrepreneur, if you have incredible, outsized traction or other things that can change that. But from my perspective, like that's typically how it works, because as we all know, there's like, it's impossible to actually value fairly a company at that stage. It's about the future potential. And so it's doing something that we often say at Kickstarter, it's like mutually uncomfortable for the founder and for the investor. Like that's where we want to be. And because ultimately, like past that round, we're hopefully 100% aligned and like, hey, we want you to own the majority of the company. We're just here to like support and hopefully increase the odds of success here in this business. And so that's how we think about valuation and then ownership targets, as we're trying to what we call like a dragon, which is a company that returns an entire fund. And so we're thinking about the math from that perspective. If we have a $100 million fund and we own 10% of a company, and we know that we're going to get diluted down to 5% by the time it goes public, then we can say, okay, we need a $2 billion company to reach that. And so we're thinking about that kind of math.
Yeah.
And as far as deal terms go, I think your goal as a founder should be to set up vanilla deal terms that won't stop a future investor from investing. Like, you should make it as vanilla as possible. Look up the NVCA docs, like just use those, and then there'll be like some changes here and there. But if you're working with a good investor, they don't want to do anything funky to the business to make it hard for you to raise your next round. You just want to keep it really clean. I think all three of us on this table, like our firms would never do anything crazy. It's different if you, like Tanner mentioned earlier, if you're going from a $500 million valuation down to a $300 million valuation, like weird things happen at that point because it's capital that it's kind of forced to be put in rather than like someone wanting to put it in. But when you're at these early stages, you just want it clean and vanilla.
Great.
Can I just add to that and like beware of hiring bankers or giving advisors a lot of equity.
Yeah.
I think those two things, whenever you see that, it can bring problems down the road.
Yeah, and just like overall, I guess when I say vanilla, like normal things are giving away 20% of your business on an equity financing. Like if you're giving 50% of your business away, a founder or an investor is going to look at that and be really uncomfortable with that because the business isn't being held by the person who has the incentive to build it. So you don't have enough value to build your business. And so there's just things that like are kind of red flags, and you'll want to look out for those.
Great. And as a follow-up to that, typically what do you see from reserve for management in terms of equity? So as you think about building out your pool as investors, how much do you want to see allocated down into the hands of the broader team, if you will, versus in the hands of the founder or the couple founders in the business?
I think at seed and Series A, the founders all together should own the majority of the business. And then, not that ideally we like to see like an ESOP of like 10% as well for key hires.
Yeah, great.
Yeah, I think there's a rule of thumb, like to start, let's say your first real, let's call it seed financing, like 70-20-10. You want 70% team, 20% investors, 10% employee option, and then to Scott's point, like you want the founding team in particular to hold the plurality of that 70%, if, the majority, I would say, of that, if not more.
Great. And for the finance professionals that are...
I would add, we have passed on companies because of the cap table. Like even at a Series A, it's just like, hey, look, we actually really like the business, but you as founder CEO, you don't own enough for us, and we can't. Like that's an exception for us, and we're not going to make an exception.
Yeah. Interesting. So, holding that closer to your vest as you sit around a coffee table with your friends, as you ideate, you certainly don't want to give away too much too early.
Yeah, I think it's to Seuss's point, I think it's fairly easy to get the data of like what's normal on both valuation and the equity that you're giving up, you're diluting, and then as well as all the other vanilla terms, and just like play for that. Like Seuss was saying, no VC's going to try to get you on terms. It's against their incentives as well.
Yeah.
In most cases.
Just for example, one of my friends raised, it was like a $500,000 round from an angel investor who gave them a term sheet for taking about 51% of their business. And I told my friends, you're killing your business before you've even started it. Yeah. If it works, great, but no one's going to invest in your business.
Yeah, makes sense. Let's talk a little bit about maybe some advice for the finance professionals who are here, whether they're looking to join a later stage startup, for example. Generally, they're not going to join at the seed and early stage, and we can talk through that in a minute. But what advice would you have for someone as you think about, particularly the finance professional? You hear the term all the time about flying the plane while you build it, right? And certainly businesses, you guys invest or potentially invest in businesses from an ideation or an idea on a napkin to as much as having a full team with all of the kind of revenues and everywhere in between. What things matter most to you, and particularly for a finance professional, what things should they focus on in that earlier part of the business development cycle? What are the key things that you really care about?
For us, honestly, like you were saying, at like the seed Series A, in most cases, if there's a CFO, it's like, what's going on here? And so, but the later stage companies that I observe or are on the board, typically the CFO is just solid on like the numbers of the business. Like when investors, like we see it most, obviously they're doing the day-to-day, which is super valuable, but as far as like what's super valuable for investors, it's like we have questions on like, okay, we hired ahead of the curve to build capacity, and now gross margins come down. What is it gonna look like when we catch back up? What's gross margins gonna be? And for, we hope the CFO like knows that info and has that data, because what investors want is just like a clear picture of the business at any point in time, and I think CFOs are crucial to that, if that makes sense.
Yeah. Thank you, Scott.
Yeah, it's not typical for us to see at the seed level a CFO, but I think what's like most important, whether you're a CFO, controller, or maybe you do like contract work for a startup, is to understand, what drives that business, their unit economics, what levers you can pull to grow the business, to slow down burn if you need to, and just, the things that impact the company most, which is cash flow.
Yeah, and I'd say I don't work with many CFOs that are, that specific. There's a few directors of finance. So I'd say like earlier stages, the CEO is wearing the finance hat, and so in those cases, like what we expect is, one, they got to know their numbers, and they have to know like at all times what's their runway, what's their burn look like, are they managing that, how are they thinking about their revenue projections, and then they're often getting help. I guess that's sort of a plug for like having a bookkeeper or somebody else maybe externally that helps out on that side, but. Yeah, at the earlier stages, we expect the CEO or COO typically to be the CFO as well.
Yep. Oftentimes, the CFO serves as the IR function inside of a business as well, managing a lot of the investor relations from that perspective. As you think about from early stage, and then certainly the investments you make as they mature and move towards the later stage, how do you see this, whether that's the board, the CEO, the management team, their communication style with you as investors and how that should change over time. What do you like to see from them on a regular recurring basis, and perhaps how does it change as those companies get larger? They're still in your portfolio, but as they get larger, what do you like to see, or how do you manage that?
I actually don't think it changes that much. Our relationship, even, at the latest stages of a company, is mostly with the CEO or whoever that founder is. And, we obviously communicate a lot with the CFO to confirm, projections or revenue and stuff like that. But the main point of contact is usually continues to be with the CEO.
Yep.
It's the same with us.
Okay.
Exact same.
Great.
Yeah, and I would just say, in general, the earlier the stage of business, we expect the margin of error or the degrees of freedom that are on, like, their projections of financials that they're presenting to be wider, and to, if you're playing the financial function, to be really thinking through what's a really conservative case. What if we don't get any of that revenue that we're projecting? What's our burn look like? What's our runway look like? If we do base case, what do we think it is? And really, like, forcing that thinking, whether they're the financial person working with the team or the CEO themselves, like, really thinking bottoms up, what is it going to take to get to these numbers, and then thinking through an expected case. And over time, as we see companies mature and get ready to go public, like, of course, like, they're pretty dialed in and they have a pretty narrow band on that. But especially early, what I expect is somebody that can think through those options and really do, like, what's a bearish case, what's a base case, what's a high case, and then, like, seeing that consistency. When you see that, then that's how you develop trust and say, okay, they're really thinking through. They're not just, like, rosy glasses, and they're not just the skeptical, like, hey, the bear case. So I think that's what I'd like to see.
I think that's a good point, and also thinking about it through different lenses of your pipeline, or if that's sales capacity or whatever that is. And that's either the CEO, if you have a CFO, or head of finance or something like that. Everyone needs to be kind of thinking of, like, their sales forecast in that way. And that's kind of, like, can be a red flag for investors if we look at, this is assuming you're Series A, probably not seed. But if we're looking at your sales forecast and you really don't know what drives your business, and you have 2 salespeople, but you're forecasted to do 5 million in sales, and you would need 10 salespeople to do that, like, it obviously isn't matching up. And we've turned down companies that we really liked because their forecast was just, like, so off that we couldn't trust them to run the business efficiently.
Yeah, great. We've got about 10 minutes left. I want to make sure we have time for Q&A. So I just have one last question for you all, and then we'll open up to the audience here for any Q&A that they'd like to ask. From your perspective, as people come to visit you, you see thousands of deals, hundreds of deals a year, fund a few. What are the biggest mistakes that you see from people looking to raise capital? And then conversely, what are the pitches that come in and just knock your socks off? What are the elements of a great pitch?
Okay, I'll start. I would say one mistake, speaking financially, to Suze's point, is having a projection. We usually don't care that much about the projections at the seed stage anyway, or at least we want to know that they thought
They're all even numbers, huh?
Yeah. But, like, they're gut check what you're projecting there, because if it's faster, if, like, you have a faster ramp to 100 million ARR than deal or ramp, like, if you just don't have any notion of what are comps, what are benchmarks in your industry, what did their growth curve look like, and you have something there, you're just kind of like, this is a little bit amateur hour. Suze's words, not mine. I didn't think that was funny. Let's see. Yeah. Other things is, oftentimes I've noticed that a lot of entrepreneurs don't give time for Q&A in the actual pitch, and I would say, like, try to go through what I would say is, like, a high-level pitch of the business. Like, here's the problem, really dive in, help understand the problem, the market, and, like, do the first pass as high level, and don't like go so deep on each go to market. Here's how we're thinking about paid and SEO, because sometimes I find that then you don't get to the core issues that the investor is thinking about, and oftentimes in terms of feedback, the investor's questions are your feedback. The things that they're asking about are the things that they're either implicitly excited about or worried about, and so as you go and pitch other investors, I would take a ledger and be like, okay, what are the questions that people are asking? What are the assumptions under that? How am I answering them? Is that a good answer? So I would think those are a few things, and then just overall being really passionate about the opportunity and having strong, what we call founder opportunity fit. Like, we want somebody that really knows the business and has earned insights into that market.
Thank you, Tanner.
I agree with everything Tanner said, so I won't repeat any of it. I would just say when you're reaching out to VCs, make sure that you're aligned with where they invest, the stage that they invest in, and find the person that you want to work with, not necessarily the firm you want to work with, because you'll be working with that person, less the entire firm, as you build your company. So, don't waste your time finding firms that do later stage. If you're raising a seed round, there's no use. They'll say, come back to us when you have $5 million of revenue. So.
Yeah, to that point, they say, right, the average VC relationship with the founder lasts longer than the average marriage. So you better pick even more wisely who your VC is. No, but just echoing all those points, I think, again, I've had plenty of pitches that have come in without a deck, and it's gone well, and we've invested. But for the most part, when you see a founder or founding team come in and they have a deck, and they're very polished, and you can tell no, they're not robots, but they know the pitch well, and they just sell you on the vision. Those are the ones that knock your socks off. When they come in and they don't have a deck, and worst case scenario, literally they start talking and don't stop talking, and your eyes are glazed over, and it's like they're not reading. Maybe it's a really good opportunity, but then you question, do they lack self-awareness, or do they lack some intrinsics that to be a founder?
Yeah.
So I just would err on the side of having structure in your pitch.
Thank you. Good advice. I'll turn it over to you in terms of questions. We'll open up to the audience for questions that you have for the panel. Yes, please.
So Y Combinator was 30. They're now at 15 to 20.
Yep.
So Y Combinator has shrunk by 50%.
Well, we just heard from someone who works with all the Y Combinator businesses, said the good ones are getting 15 to 20, and the really, really, really good ones, who knows what good is? It's probably just founder pedigree, can go for 25, but average now is 15 when it was 30. Yeah. So there's no gap between here and Utah. That's just YC's come down.
Yeah. And I think there's some sustainable equilibrium depending, given inflation and some factors that are funds have to return capital to be sustainable, and I'm sure we'll see some vintage funds that started in 2020 that don't return capital and don't continue on because of those valuations. So there's just the market's always finding that price there that was both sustainable for the entrepreneur and the venture side, I think.
I would say maybe it's everywhere, but it's been a surprise, Utah, and again, it's going to come down, but how absurd some of the valuation expectations were, where it was we can't even get to, do we like this or not? Because it's just absurd. I've seen founders shoot themselves in the foot, and come back and be hey, we learned our lesson. But again, to all the points earlier, I think it's more about finding the right partner and getting good terms, and not having some crazy valuation that you're going to be in pain growing into.
Yeah, and I would just recommend if you're going out to raise, you don't set the valuation, so don't set any expectations with who you're pitching to unless you have a term sheet and there's a valuation set. Let the investor determine what the valuation is, and then you can decide if you like that or not and go with them, or use it to find another term sheet.
Great. Other questions? Yes, please. So does board composition matter, and how does it change over time?
It matters if you're leading a round. If Pelion's leading, whether it's a Series Seed or Series A, we want a board seat. Typically at the seed, we'll do a 3-seat board seat One's the founder or CEO, one is us, and then one's an independent that's mutually accepted between the two parties. And then sometimes at the Series A, it stays the same with 3. Depends on the new lead coming in, and sometimes it's 5. So, and usually that's, if it's 5, it's the seed investor, Series A investor, CEO, and then an independent. And a lot of the times our companies just leave the independent empty, and the co-founder will come in and, either take that seat or we'll just sit in the board meeting. But
As a follow-up to that, Suze, would you turn down a deal if, say, a board had 3 members of management and they were only offering 1 to the investor?
I'd say it depends.
But there's some control. Boards are more composable than like a cap table,
Yeah.
for example. So much more worried about the structure of the cap table and if that's somehow manifested in the board composition, because you can come in and say, actually, like, here's how we want to structure it. I think from my perspective, the smaller the better earlier, and the type of investor, like there are different types of investors. So the later stage investors usually like, hey, I want to scale this. They want numbers, traction. There's others that are willing to explore with you. And so depending on what part of your journey you are on, like I've been able to see this where like a pre-seed and seed investor might be very different than a Series B. I'm not saying Series A because I have 2 here and there. I don't think they're like that, but there's some that are just like, what are the numbers? What are you doing? Like they don't care about the exploration, the experimentation that you're doing. They're more like, let's scale this. And so just thinking about who will best help advantage the company in the stage that it's at, because a lot of investors are stage specific and therefore like specialists in that part of the journey.
But you can fix the board composition in your round, and if they don't want to and you don't like it, then it could fall apart. But I've never really seen it.
Yeah.
Great. Well, we have time for one last question. Yes, please.
Are you seeing down rounds from all the frothiness last year and all the deployment? How are you reacting to down rounds?
We've seen, like, more than anyone pitching to us for new rounds, we've seen a lot of people pitching to us for flat bridge rounds. And we're seeing the same thing within our portfolio. We've had companies take a bunch of flat rounds just to extend runway a little bit. Fortunately, we haven't had like a big down round in our portfolio, but I'm sure that's pretty common, especially at the growth stages.
I'm seeing a lot of pitches of people that are not quite accepting yet. They're probably gonna have to do a down round because they still have capital left, and so I think it's to come a lot more.
Yeah, we're seeing it. We're expecting it. We've been a part of flat rounds, and we're seeing a lot of, to the point, like the tweeners, they're getting kind of stuck, like they're in between pre-seed and seed. They have not quite enough traction, or they're in between seed and Series A. And so, that's the point where you want to ask, obviously, your investors, how much are they reserving capital? How do they think about during those down times? Because that's where it matters a lot, who you have on your cap table.
Great. Again, Suze Duke from Paleon Venture Capital Partners, Paleon Venture Partners, I should say. Scott Whitehead from Elevation Capital, and Tanner Potter from Kickstart Fund. Thank you very much for your time today. We really appreciate it.
Thank you.
Way to go, guys.